Welcome back, students, to the video for Lab 3. Lab 3 video is going to be, this is the intro to Lab 3, and the reason being because I recorded actually from slide 16 onward. I recorded before, so now I have to do the recording for slide 1 to slide 16. So this is why this video will be called the intro video, and then all the rest of the material after slide 16 will be broken up into parts A, B, and C. Which is fine anyway, because the first, for this particular lab, I mean, the first 14, 15 slides are really, they're not really, I mean, they are related to our class, not necessarily to the material itself, like not really to the analytics and our programming, but it's more to give you guys domain knowledge. This is really for my BATE students that don't take any finance classes whatsoever, or economic classes of any sort, and to basically give them some more context of what's going on, what we're learning, the domain that we're learning the analytics and programming in. Obviously, the focus of the class is programming and analytics using R. But I mean, a lot of times you're like, it helps to understand why you're doing this, right? And what's the mindset behind it. So this is why I try to give a brief, very brief understanding of the investment world and what private investment hedge funds and a little understanding of this industry. So ideally, for this lab, I say, hey, we're doing active investing today, right? But ideally, what we're doing for this lab is we're actually taking our fundamental data and we're calculating our first quantitative ratio, which is going to be earnings yield, right? But we start off with, I'll have the code will be posted as imlab3code._code.r on Blackboard for you guys to use. But again, I strongly recommend you guys always type up your own code and then do comparisons. I always post my code because in case there's any kind of errors, and it might help you kind of debug. Now, passive investing. There are two terms I want to talk about right now: passive investing and active investing. What is passive investing? What is active investing? Well, for Lab 2, our first part of Lab 2, we basically calculated how much compound return your investment would have made had you invested all your tuition money into the SPY ETF. Okay, so what is the SPY ETF? The SPY ETF, as a refresher again, is an exchange. It's called an exchange. An ETF is called an exchange traded fund. An exchange traded fund is basically a portfolio of many stocks that you can buy through your broker, any online brokerage you're using. On our Market Watch stock game, we can buy the SPY ETF, and there's other ETFs, many ETFs out there. You can buy it through, if you have an Ameritrade account or a Robinhood account or a Schwab account. I think Schwab actually bought Ameritrade. Through all these accounts, you can buy these ETFs. What's the power of this? The power of this is that you can buy one ticker. You're literally buying one ticker, right? And automatically that allows you to buy X amount of stocks. So let's talk about the biggest ETF of them all. I shouldn't say the biggest ETF of them all. I mean, but the most popular ETF of them all, which is SPY. Why is SPY one of the most, if not the most popular ETF? Because it was the first ETF that allowed you to buy 500 stocks. So buying one share of that ETF, one share of that particular stock through your broker, automatically gave you ownership, obviously in very small amounts, but gave you ownership to 500 stocks. These 500 stocks are the 500 stocks that we talked about before in the S&P 500. What is the S&P 500? 500 of the biggest, baddest stocks on the planet. Minus, I would say, a few exceptions of some of the Chinese company stocks, Baidu and whatnot. Aside from that, it's the 500 of biggest, baddest stocks, right? Why is that significant? That's significant because these stocks in total make up an overwhelming majority of the market share in the public market. These stocks in total make an overwhelming amount of the earnings in our economy, in our global economy, not just American economy, global economy, right? This is why this ETF is very popular. Now, let's talk about what passive investing is. Passive investing is when you make no assumptions about the market. Zero. No assumptions. Okay. So why is it that when you buy a share in the SPY, right? And again, it doesn't have to be the SPY. It could be any ETF that tracks the S&P 500. Vanguard has their own. I should really get advertising from these guys. But Vanguard actually has their own ETF. It's a cheaper ETF, meaning the management fees are slightly less than the SPY. And by the way, the management fees in SPY are like virtually insignificant. That's another reason behind it. I mean, it's so cheap in terms of what the management fee you're paying, right? And I'll talk about the management fee in a second, in a few slides. So Vanguard also has their own ETF. It's smaller. How much in the size of it is obviously smaller than SPY, but it's virtually the same thing. Their management fee is actually cheaper. So I mean, it doesn't have to be SPY. It could be the Vanguard one. I think there's a third one. It eludes me at the moment. So why is this passive investing if you were to buy shares in this? Why is it that when you buy a share in SPYs, you are effectively making no assumptions about the market? Well, the reality is you are making one assumption about the market, just one, and this is a critical one. When you buy a share in the SPY or any ETF in the S&P 500, you are saying that that over time the 500 biggest and baddest companies in America will increase their corporate earnings. Okay, let me say that again. When you buy a share of the S&PY or any S&P 500 ETF, you are making one and only one assumption, that 500 of the biggest corporations will increase their earnings, corporate earnings, over time. Now I ask you, is that a fair assumption to make? Is it fair to say that the 500 largest companies in America, possibly the world, are going to increase their earnings over time? Hell, have earnings over time, right? Even though we're talking about increasing earnings, have earnings in this new corporate socialism world of America. Earnings doesn't even seem to matter. But will they have earnings? Let alone growing? Will the earnings grow over time? Remember, money makes money. Money makes money. Okay? My answer is yes. Emphatically, I believe majority of the population, if you pose this question to them, would say yes, that pretty much makes sense, right? Now you might be asking yourself, okay, but what if there's a situation like you have with Kodak? Back in the days, a lot of you might be shaking your head, what the hell is a Kodak, right? Kodak used to be, ask your parents about it. So Kodak, right, used to be the company, one of the companies back in the days, right? And now it's virtually gone, right? It was one of the greatest, biggest, most profitable companies ever. Steve Jobs destroyed the company when he came out with the iPhone, right? Because everybody started just taking pictures with their phones, and cameras became almost no, I wouldn't say extinct, but they became more of a novelty item or a specialty item, right? You didn't need cameras to take a picture. Well, all those cameras, they were taking pictures on the Kodak film, or a lot of them were using Kodak film. So Kodak was very, very popular and very much a necessity if you want to take any pictures. Not so with what Steve Jobs made it not so anymore. He killed it, all right? And that company's gone from the S&P 500. It used to be there. So you can make that case. And I would say it doesn't matter. Why doesn't it matter? Because once the company slips from the top 500, another company will take its place. Remember, when you're buying these ETFs, you're not buying a specific company. You're buying a concept. The concept is you're investing in the 500 biggest companies, whoever they are. Whoever they are. So yes, when Kodak slipped, eventually who's going to take its place? Right? A company like Apple. I think Apple should be in the S&P. Yeah, they definitely should be in the S&P 500. I think they're one of the top companies. So Apple came up. So even if the 500 companies you started investing with are all gone, they're going to be replaced by 500 new companies, And those 500 companies, by design, if they became the new top 500 companies, if they broke that glass ceiling, right? Are they going to be? Did they break that glass ceiling because they started making they have increasing corporate earnings? Yeah, you better believe it, right? You better believe it. So this is a safe bet to make. This is what we call passive investing, because in passive investing, you're making one assumption: 500 of the biggest corporations in the world are going to have or increase their corporate earnings, and that's just a reality. That's just a reality at this point. Another form of passive investing that's probably even more passive than that is when you buy treasuries in the U.S. Treasuries. The U.S. Treasuries. U.S. Treasuries are basically bonds issued by the United States government that are backed by the United States government. They have like different ranges. They have like the 1 month, 3 month, 6 month, 9 month, year, et cetera, et cetera. They play at this point. They're paying virtually no interest. Interest is almost down to zero, right? Uh, Ideally, is in the world of Islamic finance, interest rate should be zero. So this is very interesting from a theoretical point of view. But anyway, so interest rates are mostly around zero. So that is the other form. That is probably the most ultimate form because that is safer than SPY. Your money, when you give it to the U.S. government, you will never lose money, even if you make no money. Like your interest rate is virtually zero, you're not going to lose that money. It's a great way for wealthy people to park their money for safety purposes. The reason being is because, look, if the United States government, I always make this joke, if the United States government doesn't pay back, first of all, if they don't pay back, forget the money, your principal, the amount you lent them, right? If they don't pay back the interest they owe you, then one of two things is happening. We're in World War III and we're losing. Not that we're in World War III. That's not a problem. We have enough I think we have enough bombs to carpet bomb the world like 2 or 3 times over, apparently. Some ridiculous number, right? That's not the problem. We're in World War III and we are losing, okay? And if that's the case, then there's bigger issues than, than your investments. And the second scenario of the United States government is not paying is that we've been conquered. I guess we've been conquered by aliens at this point, right? Which again is another scenario where the last thing on your mind is your investments, all right? So, but we're focused on the SPY here. The SPY. So this is why to my students, remember in the beginning of class, the semester, I said, look, there's 2 things I want to impart on you guys by the end of the semester. I don't care if you didn't learn a damn thing. There's 2 things I want you guys to understand. One, I want you guys to start buying SPYs regularly. Okay? During the whole market drop in March, during the whole COVID thing, I don't know when you're watching this video, people are watching this video, but when the market dropped in March during the whole COVID thing, I was telling my students buy, buy, buy. My students were like, some of the students, if they started investing early, my more recent alumni got really depressed because their investments in the SPY dropped by like half. Right? I said it doesn't matter. You're doing this for the long term. Just keep buying, keep buying, keep buying. At this point now, we are in June. SPY is almost back to where it was before, even though we're heading into a recession, right? And there's different issues behind that. I mean, we could talk about that later in the semester. But the reality is, I tell my students, look, always, never. I mean, always buy SPYs. And I have some students that their paycheck comes, so you get paid twice a year, twice a month, and automatically a portion of that paycheck will be deposited in another account linked to their trading account, and the next day, as soon as there's money in that trading account, automatically they have a program so that trading account just buys whatever the price is on a cycle, on always on every 2 weeks they get paid. They're buying more SPYs, irrespective of the price. They're on just a cycle. The logic behind this is called like dollar cost averaging. Is that over time you're going to buy you're never going to buy SPYs at a great price. You're going to buy it at a worse price. You're going to buy it at like an average price, which is fine because they're buying this for the long term. You do this right after graduating, right? I know you guys have to pay back loans and all this stuff. I'm just saying take a percentage of that money, sacrifice like 1 or 2 weekends a month from hanging out or partying, and put that money in the SPY instead. And in 5 years, you're going to thank me. In 10 years, you're going to be loving me. All right. So that money is going to just be compound returning and just growing over time, right? Compound returning and growing over time. And my students that have been doing this and now they have it on automatic, they're loving it. They are loving it. They're actually asking themselves now, all right, now where do I put my money? Right, I got this chunk of money in SPY. Should I buy a house? Should I buy 2 houses? Right? Should I buy a building or something? So this is one of the two things that I really just want to hammer into you guys before the end of this, by the time the semester ends. The second thing, obviously, is making data dance using R. And you guys, we're going to start that in this lecture. I'm going to introduce you guys to the concept of data tables. Data table is a third-party data table package in R. And remember, that is what ripped off pandas. Data tables basically ripped off pandas in Python. And it's meant for massive amount of data. It's meant for processing speed and efficiency. And it has all this functionality behind it that just lets you make the data dance, right? So I don't care if you guys do stock data, supply chain, marketing data. I don't care what internship, what project, what job you're at. You are confidently able to make data dance. Like anything you can think of, you want to slice and dice the data and look at it, you can do it. You'll be able to visualize a little later. Later, we're going to introduce ggplot, and you guys can start seeing how to visually analyze the data. But your boss or your manager, anybody asks you to look at the data or summarize in any which way, you guys will be able to do it confidently, right? At least at a medium level. That's my objective for this class. So that's what passive investing is. Passive investing, you're making no decision. My students, when they're buying SPYs when they get paid every 2 weeks, they're still not making any assumptions because they're not timing the market. They're not saying, hey, oh, the market, the ETFs were this high a few days ago, so I'll wait for it to go down below this price, et cetera, whatever. No, they're not doing any of that, right? Which, by the way, any college student that's doing stock investing, that's a de facto. Everyone does technical trading. Well, the price where he was here at this price level, and then there's a third level, and blah blah blah, which is fine, right? I always knock technical analysis because everybody does it, but very, very few people are actually good at it, right? We can actually look up on the street the people in Wall Street that are actually known to be very good at technical analysis, and they are far and few in between. Far and few in between. Yet everybody does it, and everybody thinks they're good at it when their market's doing good, and they talk about how awesome they are when the market's doing good. But they get very silent when their investments tank, when they make the wrong call. That's obviously the case with technical analysis, right? You only hear about when their successes, not their failures. So, but when you're buying SPYs, if you're gonna buy it, if you're gonna hold it, and I have some students that do this, that you have the money you're gonna invest it, right, from your paycheck. But instead of doing it automatically, what you do is you will invest it only when the stock market drops by that ETF actually goes down by a few percentage points from the last previous days, right? So let's say the 3, 4 day, 5 day price was down by I don't know, 1%, 2%, 3%, and then they buy it. So you understand? They wait for the SPY to get slightly cheaper from the last, let's say 3, 4. They look at the price from the last 3, 4, 5 days, and if it's gone down since the last 3, 4, 5 days, whatever the price is, whatever the price was, it's relative. It's a percentage drop you're looking at. Then they'll buy it. They'll buy it when the percentage goes in negative, in the red, by like a 1 or 2%, right? Again, not much difference, but now they're just waiting to buy when the stock price relatively goes down to where it was a few days ago. They've now crossed the threshold, and they are now doing active investing. They are now doing active investing. Why? Because they are technically trying to time the market. Technically, even though it's very innocent what they're doing, it doesn't make that much difference. Nevertheless, they are now crossed over into the realm of active investing because they're making an assumption. The assumption they're making is that they can even within a few days they can calculate themselves a better price than if they were to just automatically buy the SPY on certain dates, right? A very small assumption, but large ramifications. The second part of our lab too that we did when you guys started picking a random stock and doing compound returns. Remember, I did Tesla. Right? Once you invest in one stock, right? Forget it. Even if you take the SPY and you time it, you don't automatically buy it at a scheduled time. You just buy it at different times, right? You have crossed over into active investing. You have crossed over into active investing because now you're making assumption. You're making an assumption that I should buy at a certain time, or I should buy a particular stock. Well, why that one stock, right? Why that one particular stock? You're making assumptions because that stock's going to beat the market. When I say beat the market, I mean the 500 stocks in the S&P 500. That one stock is going to beat the 500 stocks in the S&P market, and that's what active investing is, right? Active investing for these investment managers, they're basically trying to beat the market. They're trying to beat the collective returns of the stock prices of the 500 biggest stocks. Why? Because if they can't beat the 500 biggest stocks, why the hell are you giving them money in the first place to invest? Like, what are they in business for? You can just give your money to the top 500 stocks. And that is exactly what the general trend after 2007, 2008 has been in the stock world. The massive pension funds, endowment funds, investment funds, more wealth management funds, they've been giving less and less money to your hedge funds and your mutual funds and any kind of private investment funds, and they've been directly investing it into ETFs. They've been directly investing it into ETFs in the market, which is, subsequently, when you take all this massive amount of money and you stick it into ETF, what ends up happening is that it's creating like a positive feedback loop. You're actually inadvertently raising the price of the top 500 stocks. And as the value of those 500 stocks, or not the value, the price of those 500 stocks increase, the returns are increasing for the people that invested in those 500 stocks in the first place. As their returns increase, it reinforces their idea that, hey, I should just keep buying those SPYs, I should just keep buying the S&P 500, right? And it creates a positive feedback loop. And this is actually one of the factors, not a large factor, but a smaller factor of the whole stock appreciation when people are like, look, this doesn't make any sense from a valuation point of view. If they thought that didn't make sense, the prices now, right, when there's like so much record unemployment, yeah, that really doesn't make any sense. But I mean, there's logic behind that. It's because the Fed's pumping all this money. We can talk about that later in the Q&A session. So active investing is basically when you do anything outside of buying S&P 500 ETFs regularly. Once you step out of that, right, on a set schedule, done. You're active investing. And look, you have to be an active investor in our space, right? In our space, we have to beat the returns that those S500 stocks are giving, because I have to be able to beat what any passive investor is making. Because if I can't beat what a passive investor is doing, what the hell am I doing? Why would anybody pay me management fees for me to invest on their behalf? Right? That's the logic behind it. And this is actually why a lot of money has been moving into private. I mean, at one point it was moving into private equity and venture capital because, look, these funds were searching for returns, yield that can beat the S&P 500. The S&P 500, I think, has been shattering everybody, including these quote startup funds, venture capital, and I dabble in startup investing in startups too. It's not anywhere near, right, what the S&P 500 is doing on average. Obviously, if you find these diamonds in the rough, they obviously, I mean, they grow in multiples, right? They grow in multiples, which is what everyone's looking for. But those kind of investments are far and few, and you have to really be networked to some of the best entrepreneurs to get that done. And again, that's another feedback loop situation where the investor in themselves is highly connected to other investors and other companies that might be using those products and services. So they're a function of the growth. So I mean, that's the world of like accelerators, incubators. If you want to think of like Y Combinator and what they do, right? Y Combinator is great because they have a very powerful brand in terms of startups and venture capital because they're hooked into a network of other businesses that would use those products and services. So instantaneously, they always talk about, oh, you have the good management, all this stuff, blah blah blah. Yeah, whatever. The fact of the matter is that their ecosystem, right? Their ecosystem and their brand automatically will get massive exposure to any startup that's in Y Combinator. Like automatically, so many investors will start paying attention, and more importantly, a lot of businesses and clients, possible businesses, will pay attention and start using the product service basically overnight, right? Great example of this is Shark Tank, right? Mark Cuban always likes to mock people that come in that aren't really looking for a deal. They're just looking to be on Shark Tank because, as you guys know, all the time people always talk about they're on Shark Tank and then their website crashes because so many people are going to their website buying their products and services, right? It's like a cha-ching gold mine at that point. Um, so we veered off a little talking about incubators, but anyway, private equity. But anyway, that's what active investors are doing. Active investors are basically trying to prove that, hey, I'm so smart. I can pick other stocks. I can pick investments that'll beat the market, right? Sadly, I ask you, are they right? Does that tend to be true? Well, my man Warren Buffett, who by the way Elon Musk, criticized a few weeks ago, with I'll talk about that later. But I mean, Elon Musk obviously had a great point. Warren Buffett's not the guy, by the way, on the right is Warren Buffett, the one that looks like Grandpa. The guy on the right is Warren Buffett. Um, Elon Musk was criticizing him because he's like, look, he does a boring job and he doesn't really produce anything, which is fine. Yeah, he doesn't, right? He doesn't. But what he does, I mean, these people like Warren Buffett, they do provide a service to investors or in the investment world because they help expose any shady things that are happening with public companies, right? A lot of people don't understand that to have companies like these, to have people like Warren Buffett and these hedge funds, these analysts, what they do is they keep the public markets honest. They keep these public companies honest because these public companies, they are ninjas in terms of their financial statements, at hiding stuff in their financial statements. And people like Warren Buffett are great at sniffing that stuff out. So yes, obviously, America needs people more like Elon Musk. And Warren Buffett always talks about this. He's like, look, I do what I do because I enjoy it, but it's always, he envies people that actually make or do things because he finds those people more intelligent, right? So people like Elon Musk are definitely intelligent. Granted, the guy is self-destructive in some ways, but it seems like people like him and Steve Jobs, it's just very talented and brilliant kind of inventors tend to be like that for some reason. So let's talk about the bet. So I talked about the fact that look, active investors need to beat the market. How many times do they actually beat the market? Well, the reality is very, very. Uh, it's not the case. So you see, Wall Street has set this up as though that they're so smart, we need them, and this is why in 2008 they were deserved to be bailed out. And I remember lecturing at another university, and I was talking about this. I was invited as a guest speaker, and I said, Wall Street, and there were finance professors in the audience, and I said, listen, one of them actually worked at the Fed. So she was at the New York, she actually worked at the New York Fed. And I said, Obama's biggest mistake, and by the way, I double down on that now, especially what's going on now. Obama's biggest mistake was throwing his political capital behind Obamacare versus letting the markets, or I would say, letting all these financial firms, a lot of Wall Street, go into bankruptcy, right? And her jaw just dropped. She's like, we would enter the Great Depression. And my argument is like, no, we wouldn't have entered the Great Depression. Yes, we would have entered some sort of recession, but my argument was that it would have been a short and mild recession, and then we would have had a steady growth for all of the economy. Um, And my logic, I mean, my argument here is like, look, I was on the trading desk when these ABS and CDOs were trading. I know what was going on, right? I know basically what was going on, and either either Wall Street was either incompetent or disingenuous, or maybe a combination of both. They didn't deserve to be bailed out. And look, Goldman Sachs makes the argument that look, they didn't need to be bailed out. Goldman Sachs is like, I don't need to be regulated because we weren't going to be bailed out. Yes, our profits were going to be hurt, but we were going to be fine. We'll never know now, right? We'll never know. The fact of the matter is, if we go back to the bet I'm looking at, most investment managers actually can't beat the market. I'm going to say that again. Most investment managers can't beat the market. You always hear about these hedge funds in the glory days. They were making this much amount in returns, this much around returns, that much around returns. And that is the case. But what you never hear about is all the multiple amount of hedge funds that just go broke within a year. All right. So now we get to the bet. Warren Buffett hates, I don't say he hates a strong word. He's very critical of the professional investment management world. Very critical about it because he feels most people aren't good at it. But they charge ridiculous management fees. Ridiculous management fees, right? So, I mean, by the way, Warren Buffett taking a shot at basically the industry I'm from. So in 2007, Buffett made a $1 million wager. This is awesome. He's like, he bet $1 million to the hedge fund community and said, hey, I bet you guys $1 million that we'll give to charity, whatever, that I can beat you guys, beat your returns by betting on a low-cost S&P 500 index fund. So instead of SPY, I think he put in the Vanguard one, which is the even cheaper management fee one, and that doing passive investing in a S&P 500 ETF will beat you guys, will beat any hedge fund manager, right? So he just threw this out as 2007. The guy on the left, Ted Sades, he worked at a firm called Persia Managers. He took up the bet. Now, look, everybody, in hindsight, obviously he lost. Everyone's like, oh, blah blah blah. He lost, blah blah blah. But I mean, look, the guy had the guts to actually accept the bet. Nobody else was accepting the bet, so I don't really agree on criticizing him at all, right? I don't really agree on criticizing him at all. I think the people that do criticize are, they're like, they're being disingenuous. They're being disingenuous to the situation. So I give this guy a lot of credit for stepping up to the plate. And so he accepted the bet. And basically what he did was, I believe he took the $1 million and he invested it into 5 different hedge funds. So he gave, I believe, 200,000 to 5 different hedge funds, right? 5 different small hedge funds to beat Buffett. And Buffett just put in the whole million into the S&P 500. Now, those 5 hedge funds that Ted put the money into, he obviously had to pay them management fees, right? And we'll talk about a slide or two how hedge funds work. But so basically, he put the money in there. Long story short, the first year Ted did great. Ted was winning. After the first year, it was all Buffett. And I think 7 years in, Ted just threw in the towel. He's like, "There's no way I can catch you." So basically, what happened is Ted's investment earned $220,000 over those 10 years, right? So it's not like he lost money. He didn't make money. Where Buffett earned more, $854,000 by doing nothing. Thinking nothing, analyzing nothing, researching nothing, just putting it in the top 500 companies. Nevertheless, this had a huge impact, at least behind the scenes, because a lot of pension funds are like, what the hell? Why the hell am I giving my money to hedge fund managers, right? And this part of other social factors caused, there was a lot of flight from hedge funds to these ETFs. Now, let's talk about the payment, the cut that the hedge fund managers make. Now, let's say hypothetically a hedge fund manager manages $10 million fund. By the way, this is a micro fund. This is such a small fund. S&P 500 doesn't even look at. I mean, the SEC, the government agency that basically regulates the Wall Street, they don't even look at you if you have a $10 million fund. Like get out of my face. You're so small, right? Let's say hypothetically you have a $10 million fund and you have a 10% return, which, by the way, is not that hard right now. I could literally just buy all of. I could try to if I can buy Tesla at 900 right now. I'm pretty confident it's going to go to 1,000 before the year ends. So there's my 10% right there, right? So let's say you manage a $10 million fund and you generate a 10% return. Done. First things first, you generate what we call a management fee. This is what we call the 2 and 20 rule. It doesn't exist today because this is people negotiate, investors negotiate this now. But in the high time, like during the high time of hedge funds, like 2006, 2005, 2006, 2007, you better believe it was 2 and 20. In some cases, I heard something ridiculous like 2 and 30 rule, like something crazy, or 3 and 30. So what that means is, firstly, the hedge fund gets a management fee of 2% of whatever they manage. 2% of 10 million to 200,000. Not bad. Then where does the 20% come in? The 20% is the incentive fee that basically a cut of the profits. The cut of the profit. So let's say hypothetically you made 10% on that 9.8 million that you're now investing. That's 980,000. 80% of that goes to the investors. 20% of that goes into my pocket for 196,000. For a total compensation of the year, ladies and gentlemen, $396,000. Not bad, huh? Let's get that Porsche. All right, now let's say instead of $10 million, you manage a $100 million fund. Again, at $100 million, by the way, that's the line of demarcation right there. At 100 million, the SEC still doesn't care about you. Once you go above 100 million, then the SEC is like, all right, fine. Who are you? What are you doing? Then they start to care. Okay, so 100 million is still a baby fund. By the way, 300 million is considered a hedge fund. It's considered a baby fund. So at 100 million, you're still small. You're still smaller. You're on a smaller range of a baby fund, and you're still so small that SEC still doesn't really care about you. All right, and let's say you do the same thing again. Now, here's the beauty of investing. Whether you invest 10 million or 100 million, you're doing the same amount of work. You're doing the same amount of work, right? So now I have 100 million. Okay, I don't change anything I do except overnight my management fee now went to $2 million. I now have, think about it like a fund, operation funds, to manage my operations for the year, $2 million. All right, let's get that midtown building office. Let's get paid breakfast, lunch, dinner, right? From the top of the top restaurants in Manhattan. It has to be takeout right now, COVID, no dining in, right? And now for that 10% my incentive fee, let's say I made 9.8 mil. Now it's not 196,000, ladies and gentlemen. Now it's 1.96 million. All right. So my management fee was 2 million. My incentive fee was 1.96 million for a compensation now for not 1 second more. Well, I shouldn't say that. I obviously have to probably deal more with investors. But aside from that, my compensation went from 396,000 to $3.96 million. Okay? Now let's say my $100 million fund, instead of 20%, at 10%, it made 20%. So my management fee is still $2 million. Look what happened to my incentive fee, $3.92 million. Right? After that, that incentive fee just keeps going higher and higher the more money I make, for a compensation of $5.9 million for the year. And this is why you hear about these ludicrous compensations for these 30-something-year-old, some case late 20-year-olds on Wall Street, right? Outside of a trading desk. On trading desk, obviously, they make their money doing trading the firm's capital. But this is where these obscene compensations come from. Do they really deserve these compensations? I'm going to be very honest here. In the most case, no. But this is why we're all going to the financial world. You know what I'm saying? That's the hustle, people. That's the hustle. This is the industry we're in. And more importantly now, the trend has been changing from investing to the technology behind the investing, right? So this is why fintech is getting really hot, right? So this is like fintech is like a merging of Wall Street and Silicon Valley right here in the city, right? This was getting hot before COVID, but obviously it'll launch back up again. And I encourage all you guys, listen, you guys should check out some of these job postings of these fintech companies in New York, in Manhattan. New York City is ground zero for the fintech industry, right? This fintech industry, logically. Wall Street's here, right? So this is the hustle. And these management fees is what Warren Buffett drives Warren Buffett insane. Just so you know, when Warren Buffett started at Berkshire Hathaway, that's his whatever, his fund or whatever, he was working out of his office, his home. His office was out of his house, and he never charged a management fee. All he did was he charged an incentive fee. That's all he did. He's like, I'm not charging a management fee. That's coming out of my pocket. If I make you money, then I'll take money. So he really hates the structure of hedge funds. All right, so that's basically why passive investing is so cheap. I mean, the passive investing is so attractive. The money you're paying to the people that quote unquote manage the fund is so small, pennies on the dollar, right? Versus the professional investors, like that we, by the way, the class like our, like if you're into the material in the class, is what you aim to be, is a career path where you aim to be. Now here, what I have, I'm setting up for what we're basically learning in this class, right? So here is a small list of the active investing strategies, right? I'm not going to go through all of them. You guys can. By the way, this is This is probably a lot of different strategies here, but it's not by no means exhaustive, right? The world of active investing is a world of secrecy. Whatever, if they have a certain strategy, they want to hide it from everybody else, because if once everybody else knows it, whatever edge, whatever strategy they had, it's going to go away. So there's a whole bunch here, and the reason I bring up all this stuff, because a lot of this stuff is exciting, minus this one right here, value investing. Oh, and by the way, this is the most boring one. This is what Warren Buffett does, and this is what basically the foundations of our class. This is what I'm going to be teaching you, right? We're going to focus more on a combination of value investing and quantitative investing, right? Because we're actually going to be using ratios and simple models to pick stocks out of a massive pool of stocks, right? And to see what's attractive, what's not, et cetera, and then backtest that picking mechanism or that picking algorithm, right? So that will make it slightly more interesting. But the reason why I teach value investing is because you got to start from there. Value investing is basically your ABCs in the investing world. All this other stuff is hell of a lot more exciting. Some would say more profitable. This, obviously, statistical trading is this is baskets of trading, right? This is baskets of trading. It's what we call actually it's called statistical arbitrage, stats arb. Sometimes you hear the term stats arb or statistical arbitrage. This is probably the most consistent way of making money. Like the hedge funds, there's very few hedge funds that do this, and they basically are like ATM machines, right? It's very difficult what they do. That's like the creme de la creme of investing. But there's a whole bunch of other cool strategies and styles over here I won't really go into. You guys can look it up, right? And but this is, by the way, this is just for the world of equities. We're talking about public equities. If you were to think of a glacier, right? If you're thinking of a glacier, and think of just the tip of that glacier is outside of the water, above the water, and then there's this whole mountain of glacier underneath the water, right? If you think of that whole glacier in its totality, that is the world of securities, finance, high finance, and securities. That little tip that's above the water, that's public stocks. Meaning, even though we're focusing everything on public stocks is but a small, very tiny slice of the financial world and investing world. In fact, there's stuff there that's out there that's more exciting and more lucrative, right? Exciting and lucrative than public stocks. And obviously, that's where hedge funds really dance and play, all right? That's where they really play. But nevertheless, we start with value investing, ABCs. And by the way, I do value investing. Remember, I manage joint ventures, right? I manage and finance joint ventures, and which seems like very like high end, like market, high end business brokering or whatever, business management. But basically, the fundamental underlyings of managing joint ventures is the same thing. The concepts are the same as value investing. Basically, you're finding a good quality business that has good returns. That's basically the idea behind it, right? So that's why I teach value investing, because it could apply both in public stocks and private stocks. I don't care if you own a grocery store, you invest in grocery stores, you invest in real estate. The lessons learned in value investing can be applied to everything, including private equity. All right, so what is value investing? So here I'm going to give an example of value investing, all right? So let's assume that Wolverine, I think I was watching X-Men cartoon or something when I came up with this example. So Wolverine owns a successful lemonade stand at Rutgers Business School. He has a $400 5-year loan with a 10% annual interest rate to start the business. By the way, a business loan, basically the way business loans work, guys, is business loans, you pay interest on it every year for the term of the loan, in this case 5 years. So $40 has to be paid every year. And on the last year, you pay the interest and the principal, initial principal you invested. I mean, borrowed. So 400 in the year 5, the $440 interest has to be paid plus the $400 initial loan has to be paid back. All right. So he spends about $100 a month for supplies to make and sell the lemonade. So think about the water, the sugar. My man Wolverine has high taste. He doesn't take the water from the Rutgers fountain. No, no, no. We're talking Fiji water here, people. Sugar, right? Organic sugar, lemons, little lime, jazz that sucker up, and some nice cups. And he makes, in terms of profits, he sells $120 worth of lemonade. So it costs him $100 to make the lemonade and sell it, and he gets about $120 from his operations, from his efforts. Cyclops comes along and says, 1, stop talking to Jean Grey. 2, feels it's a good business and he wants to buy it from Wolverine. All right. He wants to buy it and own it for 5 years, at which point he would like to sell it and recoup most of his profits, right? At what price, I ask you now, what price should Cyclops buy this business? All right. We're doing value investing here, people. Make an assumption here. To answer this question of what price Cyclops should buy it, you have to understand what type of returns the Cyclops is looking for. Here we're going to assume Cyclops wants to beat our Rutgers compound return at 17%. Remember my fictional student, his Rutgers tuition, his job, his lab 1 basically. His compound return was 16.23%. Cyclops wants to beat that. So Cyclops wants a compound return for 5 years, year over year at 17%. Again, it's like he's putting his money in a bank account and getting 17% interest for 5 years, year over year. All right? Just so you know, Buffett tries to target a 20% compound rate for his investment funds. A lot of hedge funds try to do that. Why? Because 20% is a nice number in the sense that every 5 years, the investor's money doubles. So every 5 years, we talked about this, every 5 years the money doubles, right? So in 20 years, I think your money goes up like 17 times. So the first 5 years, 1 million will go to 2 million. Second 5 years, 2 million will go to 4 million. The third 5 years, 4 million will go to 8 million. The last 5 years, 8 million will go to 16 million. So that's like 16 times, let's say, not 17, that was close, 16 times. All right. So here's a basic summary. What are we dealing with here? We got an interest rate loan of $400, $100 monthly inventory of $100 we got to spend. We make $120 on that. So that means every month you're making $20. Cyclops technically would be making $20 a month. And let's make another assumption, hard assumption, that Cyclops can sell that lemonade stand, the business and the stand, for $400. All right. He can sell the business and the lemonade stand after those 5 years for $400, right? Here's some other assumptions. Demand will be consistent for 5 years. There'll be no new competition, no substitutes, meaning still going to sell $120 worth of lemonade. The cost will be unchanged, meaning it's still going to cost Cyclops $100 each month to make the lemonade. The pricing power will remain a constant. So again, that goes back to the fact that he'll be able to sell at that same price and generate that $120 a month. The lemonade stand will last for 5 years, no repairs required, and the resale value the business and the lemonade stand all in all will be $400. There'll be no damages, no repairs, no nothing. It's all good. It's some of the best crafted lemonade stands you could find. All right, now let's figure out the cash flows over these 5 years. And by the way, as I figure out these cash flows over the 5 years, please forgive me, any finance students, and please don't rat me out to your finance professors, because one of the things I won't be doing is I won't be discounting the money over time. And 1, I don't do that because I have bait students here, so I'm trying to keep this example simple. 2, I like to take the moral high ground in the sense that, hey, interest rates are basically zero, bruh, which is not really true, because for businesses, interest rates are positive, right? Not for just treasury bills. But anyway, so we're just going to suspend that just to make things a little more simpler. My finance students, you guys can take the extra step and discount it by the interest rate if you'd like. So anyway, year 1, what's the profit going to be? $200. All right. Why? inventory for 12 months, $100 a month for the inventory and the operations. It's $1,200 you're going to spend. But in terms of your revenue, your gross revenue, you're going to be making $120 a month for 12 months. That's $1,440, right? So, and I got to also pay a interest payment for that. Remember the stand. Remember when Cyclops buys the business, he takes over that loan. He got to make those $40 payments. So now, total all in, he's going to make a net profit of $200. Nice. In fact, year 2 will be the same because remember everything's staying constant. Year 3 will be the same. Year 4 will be the same, right? It is in year 5 when things get a little interesting because year 5 he's still going to make spend $1,200, make $1,440, and pay an interest rate of $40. But he's got to make that principal payment of $400. But that's okay because he is making the assumption that he can sell the stand and the whole business for $400 anyway, and now it'll be a wash. So year 5 will be $200 also. So all in those 5 years, Cyclops made $1,000. In those 5 years, Cyclops is making $1,000. Now remember, we started this with saying, well, how much should... Remember, this is what investing is, by the way. Let's take a moment to understand this. This is time travel. Investing is, financing is time travel. You're putting money, you're paying money now or investing money now, so in the future you can get more. Right? That's the whole game here. Right? Ideally, hell of a lot more. That's basically, so you're sacrificing buying watches, sushi, pizza, love pizza, fancy cars now, so that you can have more money to do that in the future. That's what investing is, ladies and gentlemen. All right? So here, Cyclops, if he buys his business in the future over these 5 years, total in totality, he'll get $1,000. All right? So how much should he spend now for this cash flow of $1,000 over the next 5 years? Remember, he wants a compound return of 17% year over year. Enter our equation from before. You remember our equation for compound return, right? It works out the same, right? You have your principal amount you invest. You have your formula for compound return, 1 plus whatever this rate is, over 5 years. Except this time, we know what we want that investment to equal. We want it to equal $1,000 because that's what we're basically getting from the investment. So the question is, what is the principal amount? What is the amount we invest? What is the amount that Cyclops pays Wolverine? So that this equation right here will be equivalent to $1,000. All right? So how do we solve this? We solve this because we know what Cyclops' objective here is year over year. Cyclops wants a 17% return year over year. Excellent. So my equation now becomes this. Cyclops wants to pay a money for the business that was going to give him $1,000 over the next 5 years, which is going to come out to a 17% compound return for those 5 years, year over year. Now it's just a simple algebra at this point. I'm going to basically take this part right here, move it under here. That's what I do here. And this is just some simple math. And so I get the number as $456.11. So my initial investment here, if it was a $456.11, and it was compounded for 17 years, compounded at 17% for 5 years, basically, he would take this money, put it in a bank account that gave 70% interest for 5 years, and it would turn into $1,000. That's the equivalent of buying the business. So basically, how much should Cyclops pay for the business? Cyclops should pay not a penny more than $456.11, right? In Buffett's case, because he's looking for 20% compound rate, it would be $401.87, right? Now, granted, Cyclops is not going to say to him, hey, I'll give you $456.11. Cyclops doesn't come in and negotiate the price. He's like, yeah, I'll give you $430 for it. I'll give you $400 for it. Wolverine will be like, no, I'll give you $500 for it. And Cyclops wants to negotiate it so that at a price below or at $456.11. This, guys, ladies and gentlemen, this is how you quantify any investment you want to make. Your parents are like, should we buy that second house and rent it out? Do the math. Figure out what your compound return should be, what do you want it to be, right? You can use the historical S&P 500 to see what this compound return has been and then figure it out what you want. Should we buy that building business? Should we do this? Should we do that? You guys can basically quantify it. If you know, if you can calculate your cash flows, if you can calculate, if you basically know what compound return you should want, you can back out what the value, what you should pay for that business day one. All right, this is not just public stocks, ladies and gentlemen. This is any kind of business you're buying. Okay, here's the problem. There's two traps we fall into when doing this value investing: the assumption trap and the price trap. What is the assumption trap? The assumption trap is all the freaking assumptions we made. Every month we will still sell $120 worth of lemonade for 5 years, right? The cost of my ingredients cups will stay at $100. What? No other competitor substitution or preference changes for 5 freaking years? Anybody remember MySpace? Yeah, exactly, right? In 5 years, in 1 year, you're gonna get competitors, right? The lemonade structure will last for 5 years, right? Your phones don't last for 5 years. And we're gonna sell for $400 after 5 years? Come on. These are assumptions that cannot be made. They're crazy, right? And I would like to point out the fact that this is just a lemonade stand, people. Right? This is a simple, stupid lemonade stand. And look at all the crazy assumptions we're making. This is the problem. This goes to the heart of the problem of value investing, right? The intrinsic value of a company is its cash flow it's generating. And it's the cash flow it generates is contextualized based on the industry it's in, the market share, its brand power, et cetera, et cetera. This means as a value investor, you have to do a deep dive into these businesses and the industry and the locations and everything they're in. RBS, what's the likes of RBS, what's the probabilities that there'll be competitors, et cetera, blah, 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 right? This is who's the customers, tell me about the profile of the customers, the suppliers, everybody in the supply chain of this business. Who are the possible, again, I go back to who are the possible competitors, what might be possible competition coming out. We can't invest like this, right? As laymen, we can't invest like this. This is why research analysts, they at investment banks, they basically, including Buffett, I think he focuses on 10 companies. They focus on an industry or sub-industry, right? When you go into Wall Street as a research analyst, and you learn everything about it. You learn, again, you learn about the CEOs, the executives, in all the companies involved in that industry. You focus on the suppliers, where they get the supplies, the raw materials, where are the factories that transform these materials into these other products, et cetera, the downstream customers, their budgets of the downstream customers. You learn everything. This is why people that, in the space, research analysts in the space of, let's say, cell phones or smartphones, they kind of can tell you how the components in the phone, and they can guesstimate to you the cost of making the phone. Also, the labor cost, the products, et cetera, blah, blah, how much it would change if they change to this region, this product, et cetera. And they're always on the phone calls with these companies or quarterly calls, talking and asking questions to the executives. So they really learn inside out this kind of stuff. As a research analyst, by the way, if you guys wanted to do investing like this or be a research analyst like this, you would apply to these programs, these research programs, rotation programs at these investment banks. Very competitive, by the way, and very brutal in terms of the time. Your first 2-3 years there, you're going to be like there 100 hours a week, 110 hours a week. So this is what they're learning pretty much, right? So that's the assumption trap. You're learning as a value investor, you must focus on a company and really understand the assumptions around it, right? But that could be fun if it's a company you care about. Like if it's a company like Tesla, right? You're all in on, okay, cool, like what's their products? Like there's mechanics out there that dissect Teslas, right? They know how it works. They try to have an idea of where the parts come from. They want to make their own parts, and they basically want to be there. They want to open up their own Tesla shops. By the way, there's a need for Tesla shops. Like there's like a Tesla obviously controls the market on maintaining Teslas, but there's a huge backlog of it. So there's an opportunity for mechanics to come out there and specialize into Tesla. But the problem is Tesla won't give you any of their parts, right? They own that monopoly. So you got these specialists coming out now. They're trying to recreate these Tesla parts. They're not going to be authentic Tesla parts, but they hopefully can be as good. And so, that's always the side hustle of the business. But nevertheless, you have these mechanics that know all this stuff inside out. And they can be very good value investors in Tesla because they understand the products in the products themselves, the supply chain. They just have to learn about the supply chain and where it all comes from, et cetera, et cetera. And by the way, this is one of the reasons why Elon Musk likes having local production in each country he's making it. So he's making it in America. He has it in California. I believe he has something going on in China, some sort of partnership going on with China for the Chinese market. In Germany, he's planning to get going. He's going to have a factory there. So he likes this. He takes this approach, this distributed approach, which is very effective, right? And he's ahead of the game in terms of production, electric car production, than obviously the mainstream companies are that are now ramping up and trying to compete with them. So this is going to be very interesting. All right, so that's the assumption trap. The other trap we deal with is the price trap. Okay, assume now that Wolverine's Lemonade Stand is publicly traded. It's a publicly traded company. It has just 100 outstanding shares, and it was trading last week at $10 per share. And today, so last week it was $10 per share. Today, all of a sudden, the stock is $5 per share. What should Cyclops do? What should he do? It went from 10 to 5, right? We're talking about like a 50% drop. What should he do? Well, your technical analyst would be like, yo, buy it, yo. Level was at 10, yo. It went down to 5, yo. It's probably going to go up another week, yo. Right? No, yo. No, yo. All right? Cyclops priced the maximum he will pay for the whole business. That means all 100 shares collectively at $456.11. At 100 outstanding shares, that means each share is each share is 1/100th of the total value of the business, right? This is how technically the concept behind public stocks. That means the highest he's willing to pay for each individual share is $4.56. He is not paying a penny more. Even if it went from 10 to 5, he's not paying a penny more. Even if the price has suddenly dropped from 10 to 5, Cyclops, as a value investor, will stay disciplined. Now, assume the price has dropped to $4. And Cyclops buys as many shares as he can, right? As he possibly can at that moment, right? Because now it went below his price that he's looking for, $4.56. And then say in a week or so, the price drops further $2. Now what should Cyclops do? Well, we have a saying on Wall Street in investment funds. I like it at this price. I love it at a lower price. So if he liked it at 4, he loves it at 2, right? If none of his assumptions and fundamentals have changed, Cyclops will do nothing, or possibly if he has more money, buy even more, and bet on the future, on the market, quote unquote, realizing that the price of the shares is less than its intrinsic value. What is the intrinsic value again? That intrinsic value is basically the amount of money that the company generates. In our case, it was like $1,000 in this example, right? Or basically $200 a year. $200 a year. That eventually the market will realize that the price of the stocks is less than the intrinsic value. The price of owning the business is less than the amount of money the business is making. That's basically it. Remember, as value investors, we make a distinction between the price of an investment and the value of an investment. There's a saying that they have for the Gulf state Arabs, right? The oil-rich countries in the Middle East, the Gulf state Arabs, that these guys know the price of everything but the value of nothing. Hopefully they're not listening to this video. They'll never do business with me again. But anyway, on Wall Street, they have a saying for that. They love. I was talking to one investor, not one investor. I was talking to a hedge fund. I was talking about to one investor from a private equity firm, and they were talking about how anytime they do very high-end real estate, and they were talking about anytime they overpay for real estate. There's no such thing as overpaying for real estate for them because they know they can always turn around to go to like Saudi Arabia or UAE and sell it for more to those guys, right? I think the market's changing a little bit because for those guys because their wealth is based on just striking oil, right? And we all know that oil's future is coming to an end. And they know this, by the way. In that region, they are very aware of the fact that soon they won't be able to give away the oil they're making in the future, right? And they're furiously trying to diversify their economy and all this stuff. So now things are obviously changing. They're starting to tighten up the belt. They started issuing tax. So before you get paid money to be a citizen of those countries, those citizens, they just get paid a monthly or annual money. That's going away, and now they're asking citizens to actually pay, God forbid, taxes. Good luck with that, right? Good luck with that. So anyway, that is the difference between the price of something and the value of something. And as value investors, we're always trying to buy something at a price that's lower than the value. So what's the price trap now? The price trap is, what if the market never ever comes to that realization? So now Cyclops spent $4, possibly $2 on these shares. Like, he's bought $4. Let's say he bought all 400 shares for $4. It went down to $2. Cyclops is like, oh, okay, fine, whatever. And the markets never realizes how cheap it is. He lost 50% of his investment. He'll never be able to recoup it, right? In the public company, in the public stocks. This is one of the risks of value investor in the public space. Because remember, in the public space, when it's a publicly traded investment, the price is always a function of the assumption of the mob. That's it. It is mob rules, ladies and gentlemen. The price is a function of mob mentality. And this is why you see all these analysts, hedge fund managers, experts, consultants, etc., writing blogs on CNBC, on Bloomberg, arguing their points about why this stock is bad and this stock is good, right? When they want to buy into a stock, it's bad. When they want to sell out, it's fantastic, right? It's bad because they want to make the price lower so they can get in, and it's fantastic because they want to get out. And they want to say, it's fantastic, I want to buy more of it, etc., blah, blah, blah. So that's the hustle, right? They have the blog posts, the Twitter feeds, everything. It's perfectly fine. It's perfectly fine, right? They just have to disclose the fact that, hey, I am an investor in this soda, etc., and this is why it's freaking awesome, right? So, I mean, it's a big hustle. It's a whole hustle that everything does. This is equivalent to one of my students when he was trading penny stocks in the Market Watch game, and he would basically talk junk. Basically, I think, like he was like just going, like just making things up pretty much about these penny stocks while shorting them in the game, and the price would like drop by a penny or something, and he'd be reaping a fortune, right? Obviously, you can't do that for real because the liquidity issues of penny stocks. All right. So this is different from what you guys learn in time series, or you will learn in time series. In time series, it goes back to what your friends do, where they're like, yo, it's this high, yo, invest at this price, yo, drop at this price, yo, this price level, yo. So that's what you're doing in time series. And I don't knock it. Like I said, if you're good, very few people are good at it, but those people are amazing if you're good at it. So that's what time series teaches. In time series, you're gonna be learning all this math. You're gonna be like, what the hell is going on? You are basically learning to discern the patterns of the prices. So for high frequency traders, for technical traders, the stuff you're learning in time series, the price is the signal. The price is indeed the signal. The movement of the price tells you where the price is going to go. For us, the price is simply just noise. It's simply just noise. It's simply just mob mentality. As value investors, we always assume, actually behavioral investors also, they assume the market always overreacts. Anytime the market moves, it overreacts. It moves too high or it moves too low. It never gets it right. Like, it's always just fluctuating around where it should be, right? And our objective is to know what the value of those stock prices are and to take advantage of the price movements. But the risk here is that the market might never ever come to the conclusion that we do, right? That the market might never get it right. This is why value investors, one, they tend to play the long game. They are contrarian by natures. And other quantitative value investing companies, right, what they will do to address this situation is that they'll invest in option contracts. So they'll start playing what we call derivatives. If you don't know what option contracts are, don't really worry about it. They're very cool once you learn about it. Finance students, obviously, you guys should know about it. There's a separate class, futures and options. Any of my finance students, they took this. There's a futures and options class the finance department offers, and it's very popular among my students and finance students in general. Very cool, seeing like this other kind of stuff that's out there. So to enter quantitative value investing, we can't really trade with this. There's two, we have to deal with the assumption trap, the price trap. So what do? We trade our style. We do it bait style, ladies and gentlemen. That's what quantitative value investing is. Quantitative value investing is where you're like, all right, all right, all right. This is how we're going to do it. We're not going to look at 10 stocks. We're going to look at 10,000 stocks. We're going to look at all the stocks in the US market, the Germany market, China market, South Korea, whatever, right? We're obviously just going to focus on US markets because that's what I got data for, right? And based on their fundamental data, again, the cash flow statement, balance sheet, income statement, and whatever data we can get our hands on, we're obviously not, this is an intro class, but in the actual industry, alternative data, which is so much more bigger than these financial statements. We are going to quantitatively build models that give us scores that basically score the stocks and tells us what should we buy, be it week to week, month to month, quarter to quarter, and what we should short or bet against. All right? Quant investors are constantly tweaking these models. They're constantly back testing it, see how they did, see what the new math out there, see what the new data it is. Basically data. Always focusing more and more data, right? And they're always trying to find better ratios or better information that unlock hidden value, right? That gives them a edge on other investors and saying, hey, this is the stock that we feel has hidden value, and the market will eventually come to realize that there's hidden value, right? And part of the game here is to part of this game is to find stocks that eventually will become attractive to the market. So you're also trying to basically gauge quantitatively what is it the market's really interested in, right? Right off the bat, what does the market really care about? Markets really loves tech companies. Market loves tech companies. What else do the market loves? Market also loves biotech companies that all of a sudden have a drug that is effective and the FDA gave approval to, right? So you see a lot of times you see, when stock prices surge, it's these tech companies, it's these biotech companies, usually, this hot stuff. But also, the market also likes, companies that all of a sudden they get restructured or they have like unexpected great earnings. Like a few months ago, Rite Aid out of nowhere, I think they quadrupled in price because Rite Aid was struggling and it was selling off its firms, but out of nowhere they had massive amount of earnings, right? Every quarter companies have to issue their earnings, and out of nowhere, like their earnings were like massive. It's something unexpected. What happens? The price freaking jumps. And obviously the market overreacts, right? So we're trying to find these hidden gems. That's the whole point. We're basically trying to say, okay, what data is out there that we can take, massage? Because remember, we're going to do trading our style that value investors can't do. We're going to take all this massive amount of data and we're going to test it, back test it historically. We're going to see what the big winners, what the big winners were. We're obviously not going to do this in class. It's a little more advanced. But technically what you would do is you would find who the big winners were, the surprise winners, and back test their data and ratios and see if there was a ratio you can come up with or that you weren't looking at that would have basically been hinted to you or signaled to you that, hey, this company is going to have good earnings. And using those ratios, right, looking at the past, recent past, by the way, you want to look at the recent past, you basically try to predict the recent future, maybe another quarter or two out, using those ratios to find hidden gems. And that's basically what quantitative value investing is, right? We take a more data-intensive, mathematic-intensive, programmatic-intensive view on finding good stocks, right? And it starts with obviously the same financial ratios that value investors use. It's the same ratios they use, but we attempt to use their models to rank the stocks and come with more quantitative scores versus what their more qualitative approach they take, right? So obviously there's a whole derivative side to this too, but we will not be doing derivatives, right? And this finally, I think this is where I believe this is where part A of the video starts off with. So then we'll talk about the 4 groups of financial ratios according to quantitative value investors. Quantitative value investors. And basically in this lab, what we're going to do is we're going to do a very simple quantitative value exercise in the sense that we're going to calculate one ratio. And in the next lab, actually we're not going to do it. For this lab, we're going to use our data to calculate a quantitative ratio called earnings yield. We're going to calculate earnings yield. Earnings yield requires us to use stock price data from QuantMod, and also requires us to use fundamental data from another data table, and I give you those data tables. All right. So this is a good ending point of the introduction. I'm sorry that it's so long, but you can skim past this video pretty fast because the rest of the material is more applicable to your class. This is just to give you guys context. So I mean, in essence, you could have skipped this part if you wanted to, but I tell you that at the end, by the way, instead of the beginning. So we'll end at this point, and you guys can start picking up the actual lab in part A, B, and C. All right. So I'll see you guys. Have a good day. I'll see you guys in the next video or Q&A session. All right. Bye-bye.